There's fresh data out on the US economy that might be even worse than what we saw yesterday. Now, in this video, I want to be realistic and straight up with you. I'm not trying to impute any bias or emotion on this. I just want to report the data to you so you can make up your own mind. And at the end of the video, I'll even go through Warren Buffett's letter, which I thought was really cool. But honestly, it doesn't make sense that all of the headlines I see in the mainstream media or on X or whatever have to do with people just regurgitating pieces of Warren Buffett's letter and complete ignorance for the data that just came out that's actually significantly more important. Now, yeah, are there cool lessons in Buffett's letter? Of course, and we're going to cover them, but let's just get right into this. Now, this is a data set that was released over the last 48 hours. It was a data set that was an initial release from the Bureau of Labor Statistics on revisions, quarterly revisions. The final revision won't be out for another couple months, but I want you to see from Moody's and Standard Chartered what some of the takeaways are so far. And I just want to warn you, they're not good. Look, I want everybody to make money. I want everybody to build wealth. I want everybody to get rich in the stock market. I'm all for it. But we need to probably start paying attention to this because it's getting worse. This comes after yesterday's PMI data. If you haven't seen that yet, just type into YouTube, meet Kevin. This is very bad. That was the title of yesterday's video, or just go into historical videos and see yesterday. That was already a shock. That was part of the reason why the markets yesterday sold down. We had a $2.7 trillion set of options expiring yesterday. The market lost $1 trillion in value yesterday. Poof, gone like that. Some people are blaming that announcement about a potential discovery of another COVID virus in China. That's nonsense. And the Bybit hack, I mean, so far everything seems pretty stable. They're back to normal operations. So honestly, their investors helped bail them out to cover what they needed in terms of losses from that Ethereum hack. But knock on wood, but hopefully those two things are contained. You could also watch my video on that COVID virus. This document is an institutional letter that I marked up discussing the QCEW changes. Now, that does not sound logical or anything understandable at all. In fact, when you start reading, it sounds extremely complicated, such as, it is a capital mistake to theorize before one has the data. The just released Q3 2024 quarterly census of employment and wages points to an increasing overestimate of employment by non-farm payrolls, even after recent benchmark revisions. Okay, none of this sounds like English, so let's just make this extremely simple. Basically, when the Bureau of Labor Statistics, or as some like to say, the Bureau of bullshit. When they put together an estimate on a monthly basis of non-farm payrolls, what they're really doing by the first Friday of every month is trying to make an estimate for the entire 30 days before that using a small sample of the United States. And what they do is they take this little slice over here and they say, okay, how many people over here got jobs, lost jobs, how many businesses were created, how many businesses were shuttered. And this sample right here, they then extrapolate to the entire month. The problem is they try to do that all within the first, 7 days. Let's give them the benefit of the doubt and say the Friday lands on the 7th day of the month. They try to do that all within the first 7 days. Best case scenario, your first 5 business days of the very next month. This leads to some really crazy over or underestimating, and this is why we come back with these quarterly census revisions, and we make modifications, and we say, you know what, all right, let's just get rid of all of this right here. And instead of using any kind of estimates of what's going on, why don't we just look at the data and see, hey, now that we have payroll data and tax return data and stuff, payroll reports and that, why don't we fill in the actual data? And how does that actual data compare to what we originally estimated? Well, when times are good, this works totally fine because things are much more predictable. But when there's uncertainty in markets and when things are rapidly changing, then it's a lot harder to figure out what's actually going on and how representative a sample is of everything that's going on in the United States. So let's try to explain this in English right here. In English, when we look at this actual document, we'll see this section right here. We see that between September 2023 and September 2024, Non-farm payroll originally told us we were generating 164,000 jobs per month. But the reality is we actually only created 108,000 jobs. So in other words, non-farm payroll is telling us that everything is fine. This is sort of your usual average expansion level of job gains, somewhere between 160 to 180,000 per month. The problem is, once you start knocking on the door of about 50 to 90,000, call it 50K in this case, this is your precursor to a recession. And what the QCEW levels are telling us is that we are only slightly closer to fine than we are closer to recession. However, we have a Federal Reserve that is paying attention to this level. Now, Jerome Powell does pay attention to the QCEW numbers as well. And this is why I think Jerome Powell and the Fed have removed their forward guidance. They don't want to give us forward guidance because they're actually starting to see that things are deteriorating on the underlying. But here's the problem the Fed runs into. The Fed does not want a recession or a crash or some kind of disaster. So if the forward guidance is going to be bad, they'd rather just shut up and tell you nothing and just say that everything is fine right now. Because I guarantee you the day Jerome Powell comes out and says, yeah, things are bad, he's going straight down. This is what we saw after January of 2022 when Jerome Powell said, yeah, it's going to be bad. And the market sold off for 9 straight months towards the end of 2022. This is challenging. So when the Fed has positive forward guidance to give, wow, yeah, inflation's going to be transitory. Inflation's going down. Housing inflation's going to contribute to inflation going down. Everything's going great according to plan. Positive forward guidance, they'll give it to you all day long. As soon as the forward guidance turns negative, guess what you no longer get? Forward guidance. Because it would just self-fulfill the problem. So this data is bad because it actually says that we are creating substantially fewer jobs. Take a look at this. Just released QCEW data show much slower job creation than the non-farm payroll have estimated over the last year through September. This doesn't even account for October, November, December, where we had probably some Trump enthusiasm leading to some hiring, but what's that going to mean when we get revisions for that period of time, especially through January, February, March, and April now? Non-farm payroll may have overestimated average month-over-month job creation by 50% between October 23 and October 24. Markets and the Fed may have perceived the labor market to be more robust than it is in reality. Okay, the QCEW data point to a far sharper deterioration in employment growth than suggested by non-farm payroll or the move in the unemployment rate, which is measured by the household survey, part of the non-farm payroll as well. At least, it suggests the Fed decisions and asset market pricing are based on imperfect indicators. This may be because of basically the sampling, the birth-death ratio for, how jobs are counted in the samples. That part is more simply explained by the little drawing that I made there. Otherwise, it gets too complicated. So then I thought, okay, well, what are other institutions saying? What is, let's say, like a Bank of America or a Goldman Sachs saying about jobs? And then, of course, we'll get to the Warren Buffett portion. Well, let's take a look at this letter, because this is a letter here from Apollo, and then I want to get into the B of A one. So the Apollo letter is somewhat appalling. Take a look at this. The consensus expects that total DOGE-related job cuts to be around 300,000 jobs, which, given that 5 million people change their jobs every single month, that might not be that big of a deal. But studies have shown that for every federal employee, there are 2 contractors. As a result, it's possible that 300,000 federal job layoffs could actually be closer to 1 million job layoffs. Any increase in layoffs will push jobless claims higher over the coming weeks, and such a rise in the unemployment rate is likely to be a consequence and would then lead to movements potentially in rates, equities, and credit spreads. So far, credit spreads haven't really seen any kind of movements, but usually when you see job uncertainty, you start seeing capital expenditures decline. Now, why does that matter? Well, because a lot of our economy right now seems to be based on this sort of boom in artificial intelligence spending and artificial intelligence enthusiasm. And that's fantastic as long as it continues. But there are already rumors circulating that following the DeepSeek sort of poison pill, if you will, maybe, and these are just rumors right now, maybe we could be getting to the beginning of a slowdown in some of the rapid CapEx expenditures. Now, I'm going to show you this. It's a rumor, and then I want to show you the Bank of America piece. But I think the rumor is worth explaining. Before I do, though, I want to make sure that we know something very, very clear about sort of my thesis here. And I made this very, very clear day one. On day one of the DeepSeek announcement, I said, you're not going to see short-term cuts to CapEx. No company wants to be the company that's implying that they're panicking because of some Chinese product. So expect it to take 6 to 12 months to actually see capital expenditures either slow for servers or chips or get repositioned to something else. And what have we noticed over the past few weeks? Well, we've noticed Satya Nadella from Microsoft start planting some seeds that, hey, we don't want to oversupply artificial intelligence. Okay, this is interesting. Why would he say that? And I'll show you that clip. And then we've also seen Mark Zuckerberg all of a sudden get really excited about humanoid robotics. Sure, that could be a way of catching up to Elon Musk, but it could also be a sign of, yeah, we're not stepping back on our capital expenditures. We're just spending on something else, of course. Interesting. Listen to, that's the wrong button. Listen to Satya Nadella yourself and see what you think. Well, you know, it would be useful, Kevin, if you actually set the audio output to something everyone can hear.
Aiming some AGI milestone, that's just nonsensical benchmark hacking to me. The real benchmark is the world growing
right
at 10%.
The world economy is 100 trillion or something. If the world grew at 10%, that's like extra 10 trillion in value produced every single year. If that is the case, it seems like 80 billion is a lot of money. Shouldn't you be doing like 800 billion? If you really think in a couple of years we could be really growing the world economy at this rate, and the key bottleneck would be, do you have the compute necessary to deploy these AIs to do all this work?
The classic supply side is, oh, let me build it and they'll come.
Here it is.
I mean, that's an argument. And, you know, after all, we've done that. We've taken enough risk to go do it. But at some point, the supply and demand have to map. You know, you can go off rails completely when you're like all hyping yourself with all the supply side versus really understanding how to translate that into real value to customers. And you're not going to say, oh, they have to symmetrically meet at any given point in time, but you need to have existence proof that you are able to parlay yesterday's, let's call it, capital into today's demand so that...
In other words, can we actually prove a return on our investments? And maybe before we keep blowing money, we should make sure that the money we've already spent is actually making us money. This is weird. And this interview comes, you know, within 4 weeks of the DeepSeek announcement. And again, I understand. There are a lot of people who say, but Kevin, I just learned about Javon's principle or paradox. And it says that when something becomes more efficient, more people are going to use it. Yeah. Listen, I agree that more people are going to use AI over time. Deep research tools, which are really just prompting for you over and over and over again, they're great and they're going to lead to more use. That's fine. I believe that. I believe that AI agents will lead to more usage. The question is, A, will they lead to more actual revenue for companies, or does this just become the new commoditized standard? And B, if the chips are 100x more efficient, but our output is going up by 2x, then yes, we are 2xing how much artificial intelligence we are using, but the infrastructure needs that we have are actually 50 times smaller. So in other words, there is a substantial risk of oversupplying the infrastructure. You know, the Javon's paradox comes from this idea of, oh my gosh, well, if engines are more efficient, then we're going to need less coal. Okay, well, if the people who are claiming that Javon's principle will lead to this never-ending AI chip spending boom, then if you want to apply that to the good old, steam engine powered by coal back in the day, you could just say, all right, we have 100,000 tons of coal. Oh my gosh, a more efficient steam engine? Javon's paradox. Quick. Instead of needing 100,000 pounds of coal, we need 1 billion pounds of coal. There's still a mismatch between the supply and the demand. And that's exactly what Satya is now planting the seed with, which is interesting because it's coming just at the same time as labor revisions are showing us things that people who've been paying attention very closely have already been watching for many months now. Certainly since last July, these problems have really started to become more evident. But also, I want you to see this. You know, yesterday, Tom Lee was on CNBC doing the usual, oh, people are full of cash. Everybody's got all the cash in the world. Oh, all the dips are going to get bought. Okay. I mean, I haven't ever heard anything else from Tom Lee, but, I'm still waiting for the all-time highs in small caps. But anyway, what do we have here? This is Bank of America's flow show, which indicates that at Bank of America, their customers who manage their assets with them only have about 10.9% of their assets in cash. They're actually 63.5% exposed to stocks, which is the highest allocation since March of 2022. Basically the peak following, December of 2021, but it took 4 months for people to realize, oh crap, the market's actually going down. We have now seen the biggest inflow into treasuries in 6 weeks. We have seen the biggest outflow out of tech in what is this, biggest 3-week outflow on record ever. Interesting. We've also seen that investors are still quite bullish, but there's a slump in cash as a percentage of assets under management, just 3.5% on average. This is different from the investors over at Bank of America, apparently, who are about 10% in cash. But these numbers don't necessarily agree with what we're seeing some other folks say. In fact, something else to consider here is what Bank of America calls the bull disruption. They think that there is a potential risk of an unanticipated slowdown in growth on housing, the tailwinds of a wealth effect, job growth tailing off, inflation nagging consumer confidence, U.S. government heading into recession, basically the D.C. recession, and basically the things that were supporting spending, such as the U.S. government exploding its discretionary spending by 65% over the last 5 years, that going away, yes, while it may go to less waste, also fuels less of the economy. So anyway, a slowdown. This slowdown is starting to be flagged by outperformance of bond sensitives and defensive stocks. Interesting. Now, by itself, government spending only works out to somewhere around 7% of GDP. But when you consider the multiplier effect of wasteful government spending, or just government spending in general, you tend to have this large multiplier of like 5x. And so people regularly argue that government spending is responsible for somewhere around 35 to 48% of GDP because of the downstream effects. And so this is where there's this question of if there's a recession in Washington, D.C., assuming unchanged Trump taxation, of course, Trump wants tax cuts, then we're probably going to be in a situation of more government deficit, not less. That's because at the same time that, you're trying to cut spending, you're not going to be able to cut enough before you hit a recessionary catalyst, and then you'll be right back to spending. Versus, if you're trying to cut taxes, that's great, but how are you going to make that all up in tariffs? Well, you probably won't, and we already know that tariffs are economically just not the best idea. They tend to create too much deadweight loss. So this is where I actually argue. I think there's this potential that DOGE stimulus checks might actually be closer than we think. I know it seems crazy right now when the market's at all-time highs, but what ends up happening is if you walk into a recession because of some of the data that we're starting to see, I think there will be quite a bit of enthusiasm for government stimulus again. But that's my opinion. We don't have to focus on that so much right now. Instead, Bank of America is actually recommending the 30-year bond right now. I actually think that's very interesting as they see a potential flatter yield curve. Now, in a shock, we would probably not just see a flatter yield curve, we'd probably see a substantial drop in the 2-year treasury, which would also pull down the longer-term end. So, TLT becomes interesting in the event of a shock. We don't know with certainty that we're going to have a shock. So putting all these pieces of the puzzle together, things are looking a little, okay. At the very least, we should pay attention to these things, right? Consider this for a moment. Job data likely weaker than expected, terrible PMIs yesterday, consumer confidence is starting to slip, optimism that we had immediately after and immediately before, actually, the Trump election has started to wane because we've started to go, all right, What is all of this actually going to mean? What kind of tariffs are we going to get? What, the pull forward that we had for tariff spending has sort of already been had. So now it's like, all right, where's the new demand? Growth forecast slower than expected at companies including Walmart. Although Walmart wasn't really that bad, and Walmart tried to blame it on their TV manufacturing business that they bought. Well, technically it's a designing business since they themselves outsource. But anyway, you put all of that together, it does create some uncertainty. Now, sometimes uncertainty is a great opportunity to buy the dip in stocks. Personally, I think that if the only uncertainty we face is this H5U, I don't know what, it was Hong Kong U5, the HKU5 CoV2 variant of this sort of bat COVID. If that's the uncertainty leading markets to sell off right now, that's probably a nothing burger. I would argue with a 97% certainty it's a nothing burger, and you can watch my video on it. If markets are selling off because of drama over the Bybit hack, then that is also a buy the dip opportunity. Markets have become sophisticated enough to realize that if they don't step in to bail out a potential bank run, then they end up collapsing like FTX, and it leads to substantially larger problems and more losses. Now, when it comes to this employment data, well, that's what makes me concerned, because most people seem convinced that, oh, well, everything's fine. The labor market is fine. Look, jobs are still fine. But I think people forget that recessions usually are defined in the past, in the rear view mirror. And this is actually really problematic because it takes away your predictive power, and it means you have the highest likelihood of being caught in a shock. Now, this is the kind of stuff we talk about in our course member live streams regularly. And this morning we were doing a HIMSS analysis and their exposure to GLPs. Do you know how many of their customers are subscribers because of GLPs? Do you know how many of their customers are senior citizens? These are important things that we dive into to evaluate, okay, what could a potential revenue impact be at HIMSS if they lose their ability to utilize a compounding exemption? If you don't know these things, I really encourage you join the course member live streams on a daily basis. You get 2x watch them back, and I'll even post summary notes on these fundamentals. Just go to meetkevin.com. You get trade alerts, you get lifetime access, you get long-term investing theses, tax strategies. These are really advanced, from basic level finance to advanced level finance topics that are really designed to help you get to the next level. So check those out over at meetkevin.com. But if you go to the St. Louis Fed and go to unemployment rate, it's worth noting how much of a lag there is in when you actually end up seeing the unemployment rate spike relative to recession. And so, as an example, if I pull into the dot-com bubble recession or the 2008 recession, you don't actually hit peak unemployment until the recession is essentially over. Now, this is quite shocking, but if you look, the stock market bottomed somewhere around March of 2009. The stock market started tanking around March of 2008. So notice how the stock market actually tanked before the unemployment rise came, and the stock market bottomed before the peak of unemployment. Now, the same thing was true over here. This stock market started falling, in 2001, late 2000, and you didn't actually really see the peak of your unemployment until basically the turn of 2001 to 2002. Now, that's really interesting. It's worth paying attention to as well. And you ended up getting your bottom in the stock market in March of 2003, but you didn't hit peak unemployment until you had this other surge over here in June of 2003. So in other words, the market seems to bottom about 3 to 6 months before you hit peak unemployment. But we're at the top right now in the stock market. So you haven't gone through a bottoming process yet, if this is a potential future. Now, again, is this an argument that says, and then we're going to get into the Berkshire letter here, is this an argument that says, oh my gosh, sell everything? No, of course not. I'm not your personal financial advisor. But I do think it's an argument for being cautious. How can you be cautious? Well, one of the ways you could be cautious is diversifying your investments. Private market opportunities are interesting because they're less exposed to the volatility of the public markets. So, for example, at the moment for accredited and hopefully soon for non-accredited, our investors into HouseHack receive a 5% yield on their investment. In addition to 5%, which just 5% alone, that's not a big deal, but in addition to the 5%, you get 100% of the upside in the stock. So, if we end up over, the next 6-7 years or whenever between now and IPO time, if we're able to 10x, 20x, 50x the company, I have no idea what it would be. Hopefully it'd be something great like this. You capture all of that upside, and between now and conversion, you earn 5%. That's just an example. You don't have to invest in my real estate company. It's real estate. It's not for everyone. But diversifying is one option. Another option is looking into treasury bonds. Those are another option. You capture some yield, and you can do what Warren Buffett does. Well, Warren Buffett just goes for up to 1 year treasuries, 6 to 1 year. I think 6 months is his favorite. Another option is pay down debt. There are a lot of people with outstanding margin. In fact, we could look FINRA margin outstanding, and I would be really nervous about some of these levels because we're at all-time highs on margin outstanding right now. Stand by. Let's see here. There it is. All right, here you go. Margin statistics. Look at that. $937 billion of margin outstanding. It's the highest, at least in the chart that we can see here. We can get some historical data too by going through the download of the data, but this is substantial. So this is going to be something to pay attention to. I think we may have been beaten by this once at the end of 2021 or so, and then margin just absolutely collapsed because so many people got burned. Margin's great when markets are going up, but there's a sudden shock. Oh man, you're borrowing money to lose it. Oh, it's bad. And then you have the panic of the potential for a margin call, and it just leads to poor decision making. So reducing debt is usually a psychologically smart thing to do. I know how burdensome it could be to not want to pay off debt because it's like, oh, but if the stock just bounces back a little bit. All right. Well, I just want to make sure we talk about this at the top of the market, okay? Anyway, so the Berkshire letter was interesting. I'm just going to point out some of the highlights that I found interesting. I'm not going to read everything here, but I love the argument about praise by name, criticize by category. So don't speak poorly about an individual. Instead, criticize the category when you're talking about, let's say, reviewing a business or whatever, and then praise people by name. I find that very interesting. Then he talks about how important it is to realize that managers aren't perfect and more managers should admit that they're wrong and they've made a mistake, because then you can actually start solving the problem. Right? What do they always say? The first step of solving a problem is identifying or admitting it. Anyway. He talks about, don't fool yourself into not acknowledging and solving mistakes. He goes through some stories that are quite interesting, how he talks about how he never looks at where somebody's school is that they went to. Talks about how 53% of their 189 reporting businesses or businesses that they own or have ownership in reporting a decline in earnings. Now, Berkshire did better in part because of the treasury income they had and then also the insurance business. They talked about how there really weren't major storms, that of course there are claims that they still pay out on asbestos, which have been going on for 30 years. There are short-term claims that they'll have to pay out for storms or fires, but some years you'll get multiple mega storms in a row. And he talks about them not having been exposed to these in 2024 and helping increase their income in the short term. But be careful because, you could have a really good year and then you could have a really bad year with insurance. He also says that sometimes businesses will blink yellow and give you a warning sign, and you should pay attention to those warning signs. So he says that the Treasury Department knew that Berkshire Hathaway was going bankrupt. The furniture business was going bankrupt because they kept the shell, right, and used it as the company is now. The shell was going bankrupt. And the Treasury Department knew that before anybody else did because he stopped paying taxes to them at Berkshire Hathaway because they weren't making money anymore. It was basically saying, hey, sometimes a business can look cheap because its income is going down, and you have to be careful because that could be for a reason. Maybe that company is bleeding out. Then it talks up America, how great America is, how much money they've paid in taxes. It takes a slam at other companies that aren't paying a lot of money in taxes because of tech loopholes or whatever. Talks about how they don't have a lot of flexibility in the markets, mostly because when they make a move, it's so large, it takes them a while to get in and out. Then he talks about foregoing on dividends to reinvest at the company. We've heard some of these things before. Talks about investing the float. This was fascinating too. He talks about that when CEOs are paid on a level of performance or stock exposure rather than option exposure, it's an approach that encourages caution but does not ensure foresight. I don't know if how much of that is true. His idea is basically if the stock goes down, the owner loses money as well, like the CEO. I get that. But what I really liked was the line that you could do something that encourages caution but does not ensure foresight. You can't guarantee that you'll see everything that's happening or going to happen in the future. I thought that was fascinating. It talks about how they're not going to lower their underwriting qualities. Talks about his investments in Japan and how great Japan is because Japan's gotten so cheap, blah, 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 blah. Then they actually just kind of go through the investor day of what they're going to do, how they're going to talk to Becky quick, and some scheduling stuff. So that's really it for the Berkshire letter. I really think some of the other things that we talked about, though, are much more important. And we know that Warren Buffett's cash pile is at all-time record highs. We also know that he doesn't try to time the market. His take is just look for good opportunities. And he sees a substantial lack of good opportunities right now in markets, which is fascinating. I still see opportunities. We talk about them with course members. But I could see for his scale, there are going to be fewer because they've got just way too much money to deploy for it to make a difference. They can only put so much money into a small company before they move the stock themselves, right? Anyway, with all that, I think it's worth listening to the rest of what Satya Nadella here said, and then we'll do sort of a little summary here. It's a lot of information.
Then you can again invest, maybe exponentially even, knowing that you're not going to be completely rate mismatched.
I wonder if there's a contradiction in these two different viewpoints, because look, I mean, one of the things you've done wonderfully is you make these early bets when there's you invested in OpenAI in 2019, even before there was Copilot and any applications. If you look at the Industrial Revolution, these 6-10% build outs of railways and whatever things, many of those were not like we've got revenue from the tickets and now we're gonna
There was a lot of money lost.
That's true. So if you really think like there's some potential here to 10x or 5x the growth rate of the world, shouldn't you just like let's go crazy, let's do the hundreds of billions of dollars of compute?
It's not about building compute. It's about building compute that can actually help me not only train the next big model, but also serve the next big model. And you understand until you do those two things, you're not going to be able to really be in a position to take advantage of even your investment. So you have to have a complete thought, not just one thing that you're thinking about.
All right, so that was really the rest of that, just to cover that as well. I mean, again, this idea is very simple. It's like, let's prove that we can make money first, and then we can keep spending. As long as we can exponentially make money, we can exponentially keep spending. So put all of these things together, and I think when you put them together on a list, it becomes something that, at least merits some caution. Cash levels by at least institutional surveys are quite low, right? So let's write these down. Low cash levels. Something to pay attention to. What's another thing that we want to pay attention to? Well, the lagged deep seek effect, right? So lagged deep seek effect. This mainstream media argument that I think is so interesting is you've had a lot of people say, oh, well, the deep seek effect didn't do anything because CapEx spending didn't go down. Look at, Microsoft, Amazon, Meta, whatever. Okay, but they reported earnings 5 days after the deep seek effect. 5 days isn't enough to adjust. 6 to 12 months. And this is what I've said since day one. Just be careful. It's like a cancer that has been planted. So watch the CapEx redirection or slowdown, low levels of cash. Watch these job revisions. Also, a lot of talk right now about growth or lack thereof. And remember what happens when growth slows down. When growth slows down, companies lose their PP. Nobody likes losing their PP. When their pricing power goes down, they end up taking it in the margin. Okay? Small PP, taking it in the margin, these are problems. And they all lead to eventual, but not immediate, job loss. Job losses. There we go, whatever. So just watch all of these things in your investing career. Be careful. I personally think there's still opportunities in high quality real estate, specifically single family, mostly because I have this vision. So we're going to call this section Kevin's vision. And it's I'll call it my bear vision. Bear vision. My bear thesis is that we end up in a deflationary recession. And this is going to be marked by 10 to 14% unemployment. The problem is this will be quite sticky. And the reason I say it'll be quite sticky is because I actually think the beauty of AI will make it harder to rehire. This will actually make it harder to come out of the recession, to escape the recession. It will take much longer to get out. You could see flat returns in markets for years, many years, because you need people to go back to work to get the consumption going again, right? This is where I think there's the potential you start seeing some more clamoring for DOGE stimulus, but I don't think it's going to do much to actually create jobs. It might create temporary little boosts in spending like what you saw in China, but it doesn't sustainably change anything. In our COVID recession, when we were stimulating what was actually a relatively strong economy. But Kevin's bear vision here is a deflationary recession that's really, usually how it starts. So it starts with a market slowdown, some early indicators of labor market stress. Then after that, the compounding effects take hold. So compounding hits, weaker growth, more layoffs. This is a cycle, right? We end up in a deflationary recession. So this means prices go down, but people have less capital. Risk assets go down in this. Risk assets down. So this usually means that things like gold, bonds usually do well in a recession, but a deflationary recession, may not do as well for gold. I don't know, because gold has already been propped up on this idea of tariffs and inflation. So how much of that gets replaced with deflationary? I don't know. But usually gold and bonds do well. I would guess that if we hit a 10 to 14% unemployment rate, we're probably back to 0% interest rates and QE. AI will make it again harder to rehire, which just leads to more QE, right? More QE. It'll make it harder to escape recession, and really, probably asset owners will end up doing the best, people who can leverage their assets for debt, for cheap debt. And so I think leverageable assets will become very, very valuable. To me, the easiest one is just real estate. But then again, that's my world of expertise. Apparently, I can't even spell leverageable. Maybe because it's not a word. Put the E in there. Anyway, so whatever. I don't want that to happen. I mean, sure, it'd be cool for rates to be back to 0% again, but this would be terrible. The economy will be in a poopy duper for a while. So I don't love this bear vision, but just the data that we've gotten over the last 2 days has increased the likelihood of this to me. So, 3 days ago, put me at 4.8 on the bear bull scale. 100%. So like a score of 1 would be sell everything. A scale of 10 is margin everything, all in, baby. I was probably about a 4.8 3 days ago. I've been kind of more in the middle the last couple months, just sort of like, wait and see. The data we got over the last 2 days, the last 2 days of data probably put me closer to like a 2.4. So, I don't know. make with that what you like. But you know, I don't have any options on the market in terms of like shorts on the market or whatever right now. I've got exposure to bonds, just to be transparent, via options and actual holdings, but that's mostly because I think bonds are great. I think they are probably going to be one of the best performing assets in 25, but we'll see. So I know bonds are kind of boring though. they're not fun. So that's my take. Thanks for watching. Goodbye. Good luck.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.